And we are live. It's Wednesday afternoon. Let me ask you a question. What happens to bonds when interest rates rise? You might have been Googling around and you found this video on Facebook or on YouTube. My name is Wes Moss, Chief Investment Strategist at Capital Investment Advisors, an income-oriented investing firm. We think a lot about, hey, what happens to what are supposed to be safe investments that pay interest, bonds, when interest rates go up? We've been talking about interest rates going up for many, many years. And here we find ourselves, and by the way, this is what we're talking about today. What happens to bonds when interest rates rise? Well, I'm going to draw you a couple of pictures today to help explain that. So we buy bonds to generate income. We want to get interest. I might buy, and a bond is essentially an IOU from a company or the government or a municipality, and you effectively lend them money by buying them a bond. It's kind of like an IOU. And let's say that you put $10,000 into a bond for the state of Georgia. They go build a bridge, and they say, we'll give you back your $10,000 at the end of 10 years, and we're going to pay you 4% a year in order to do that. Well, so we have to think about, A, is the company going to pay me back, number one, or the municipality? Or two, are we going to get, how much interest am I going to get along the way? And then how long is the term? Well, that's what's important about understanding what happens to bond prices when interest rates go up. Just a quick recap of where interest rates have been over the last, let's call it the last 50 years. There's a quick chart here. Let's go back to the 1970s. Let's go to today, and we'll see here that at some point in history, and this is back in, let's call it 1980, interest rates had been rising and rising, and in 1980 they peaked at about 14% for the 10-year Treasury. Today that number has effectively come all the way down here to let's call it around 2.1% on the 10-year Treasury bond, and that's where rates are today. So they've come down dramatically over this super long 30-plus year period of time. Well, the question is, what happens over the next several years if rates start going this direction? Let me draw you the relationship between bond prices and bond yields. So here is one of my favorite diagrams. It's pretty simple to follow. It's really effectively, think of it as a seesaw. So this is my fulcrum, and I'll see if I can draw a straight line here. So let me go use my book, You Can Retire Sooner Than You Think. Just a subtle promotion of You Can Retire Sooner Than You Think in order to understand what happens. So take a look at this. We have prices here, or dollar prices of your bond. And then this is interest rates. Think about interest rates on this side of the fulcrum or this side of the seesaw. And also think of this as, let's call this time too. So let's say this is a 1-year bond, a 2-year bond, a 5-year bond, a 10-year bond, a 30-year bond way out here on the seesaw. So I know that, and what's been happening for the last 35 years, interest rates have been coming down on this side of the equation, and that means prices have been going up on this side of the equation. So this is what things have looked like for the last 35 years. I buy a bond at a 5% yield. A few years later, that 5% yield looks really attractive because now rates have gone down and they're 4%. So my old 5% bond looks more attractive. So what happens? Well, the price goes up to compensate for that. The same thing works on the other direction, or in the other direction. And this is what investors are worried about today. And if you own a bunch of bonds, particularly long-term bonds, you really have to start thinking about this as rates have continued to go down because of all the tensions in the world, and people buy up bonds and bond yields go down. Now, what happens when the world starts to calm down and the Federal Reserve starts to raise interest rates, or continues like they've been doing, and rates really start to go up? Today, again, the 10-year Treasury is close to a very low 2%. What happens when that gets to 4% is the question mark. Well, we know that as rates go up, though, this same relationship works the other way. Prices start to come down. So over the course of the next several years, and economists have been talking about this for a long time, and investors have been talking about this for a long time, But when rates finally start going up or north, particularly way out here on the fulcrum, long-term bonds, you get the most movement in price on the downside. That's why it's important when rates are going up to either own floating rate bonds that effectively reset and erases this relationship, or if you're going to own bonds in the short term, imagine owning a 1-year bond or a 3-year bond that's really close to the fulcrum, let's say. Let's call these 1 to 3-year bonds, and rates go up. Well, not a lot of movement here in price because we get maturity in a very short period of time. My bond price doesn't move much if it's only a 1 to 3-year maturity because, hey, I'm getting my full amount of money back in just a few years. If I'm way out here and I'm thinking about, my goodness, I have a 30-year bond, I'm locked in to those 30-year bonds, so my price is going to move dramatically when interest rates rise. So I just want investors to be careful understanding this pretty simple relationship when it comes to bond prices and bond yields. And if we're in a cycle where interest rates or yields start to go north, we've got to be really careful about our price of bonds coming down, particularly when we're way out here on the fulcrum. Where do you want to be when rates are starting to go up if you're owning bonds? Well, if you don't want to worry about your price moving a lot, you want to be in this range closer to the fulcrum or closer to short-term maturity bonds. So that's the relationship, and it's a really important relationship to understand as an investor, particularly as an income investor, as you consider what's happening over the next several years. Part of the reason we have seen rates come down is that when the world gets really scary, and arguably we're in a scary place, anytime North Korea rattles their saber, we get worried about, well, what if there's some sort of geopolitical event, or God forbid there's some sort of war? Where do investors go? They go to the safest areas of the world, and the safest areas or investments on the planet, technically from a credit perspective, U.S. government bonds. So when you get demand for bonds for safety, and people want to buy bonds, investors buy, and prices go up, as we see here, as we raise prices, we see interest rates again come down. And that's what's happened as tensions in the Asia-Pacific region have really risen. That's the relationship we have to watch for as investors, and an important lesson here today. So thank you so much for tuning in. Of course, Wes Moss, again, Chief Investment Strategist for Capital Investment Advisors and host of Money Matters on WSB Radio, Sundays 9 until 11. My website, wesmoss.com. If you have any questions you want to direct directly to me, contact button upper right-hand corner. Thanks so much today for tuning in.